Cette
Uh,
conférence
so,
va maintenant être enregistrée.
okay, I'm happy to share some tips and insights from my personal experience about the fundraising process with you today. So I know that some of you have already raised some money before. Some are from grants or some others from private investors. So the purpose of this presentation is really to give you some more general background information so that you can be better prepared when you go outreach investors. Okay, so as an entrepreneur, I guess you all know that basically you will encounter these two type of investors at your early stages. Angel investors, so we have two business angels with us. They are mostly high net worth individual who provides capital to you for exchange of equity. Most of the time, either they will provide one-off funding or that they will give some ongoing injection to support your company at these early stages. And then we have venture capitalists. Basically, these are professional investors, provide capital to your company, especially to those companies with high growth potential. I highlight this word because it's really something very important for venture capitalists. And their purpose in the end is really to realize profitable exits from these equity investments when the companies that they got invested either got acquired or go public. So what VCs do, so what is their job? I list some daily tasks for VCs, but the list is not exhaustive. It's just to give you some general idea. So basically, VCs, they raise money from LPs, limited partners. I know that Klaus is currently going through this process, so probably later he can share more details with you guys if you have any questions. Basically, these are the money that they raise from the institutional investors, and then later they will use this money to invest in your company. And VCs, they spend time on sourcing high quality deals, high quality entrepreneur teams, and gaining access to the best startups. This is really a very important step for them. Most of the time, they really spend kind of like continuous efforts on this process because without a high quality deal flow, that they cannot really realize a quality investment later. And they spend time on evaluating, selecting the investments that match their investment thesis and strategy. And then they will work with you guys on the term sheets, on the economic and control terms that later we will cover a little bit, but you will have this discussion more in detail in the next two webinars. And finally, once they got investments realizing in your company, they will support you in your development, whether in go-to-market strategy or business development, product design, etc. So here is a additional value-added service besides the financial support they will give to you. And of course, in the end, it's all about making profitable exits with capital gain for VCs. So I think it's important that if you want to go out there to raise money from VCs, should definitely have just a basic idea of the current state of VC industry. Basically, I highlight some key points, but Klaus can definitely add more points on that. So basically, today's VC are facing increasing competition. So these were really a lot of VCs out there compared to 20 years ago. And basically, there is more capital out there than great ideas. So not every great ideas can really have all the money from VCs. So the VCs really have limited opportunities that to access the best entrepreneur out there. And in the past years, we see that, especially during COVID, we see that mega funds, they are actually continuing to raise money in the market, and they are quite easy for them to raise money. But while smaller funds, they are really struggling to return money back to their limited partners and struggling with their profitability. and return on investment targets are becoming challenging to be achieved by VCs. So let's dive into the VC ecosystem. So how is the VC ecosystem organized, and how does it look like? So I want to share with you a graph that you can probably give you some ideas. Like I said, that most of the time your contact will be the VC investment firm, which is here. They got another professional name, is called general partners. Like I said before, these VC investment firms, they raise their money capital from their investors, which is called limited partners. These limited partners are usually insurance company, pension funds, university endowment funds that they look, for alternative investment opportunities to diversify their investment risk. So startups business turns out to be a quite good alternative for this limited partners. And there is a trend out there on the market is that more and more limited partners, they're actually looking to invest directly in startups today, instead of going through some VC investment firms. But that's just an emerging trend. But most of the time, they still invest through VC investment firms, and then VC investment firms, they create different funds, and they allocate different capitals to different startups out there in their portfolio. So if we dive into the relationship between limited partners and general partners, we see there is a key legal documentation which is called limited partnership agreement. And basically, this is an agreement which outlines some basic terms that governs the relationship between LPs and GPs. I will not go into details into this. It's quite complicated, but I just want to highlight 3 key terms that probably you have already heard about before. Management fee, or basically is the annual fees that the LPs will pay to GPs for them to manage the capital. And the carried interest is usually the profits that the GPs will return back to LPs. And then lastly is the GP commitment, because most of VC investment firm, when they set up a VC fund to invest in startups, usually they allocate some of their own money alongside the limited partners to invest this money into startups. And if we go deeper into the relationship between VC investment firm and startups, so you will mostly heard about the term sheet and the share purchase agreement. So these are the term sheet is just a non-binding agreement that will govern the relationship between GP and startups, and the purpose to minimize any potential risk during the execution process. And the share purchase agreement is just a binding agreement that everything is finalized and you have all the major terms figured out in this document. I just highlight some key terms that you will go deeper into these terms later during the following up webinars. So basically you have valuation, the pre-money or post-money valuation. Liquidation preference is mostly the preference that VC investors they have when there is a liquidity event out there. So liquidation preference is pretty tricky, and you should really pay attention, because sometimes some VC will really put a lot of time and efforts in negotiating liquidation preference with entrepreneurs to end up with a attractive upside for them at the moment of the liquidation event. But probably for entrepreneurs, it is sometimes they just couldn't get a lot of upside from it. So you should definitely pay attention to this. And then ownership target is just about how much percentage of the company you want to give away, and what is the control that you want to have on your company once VC come into the capital. And And also lastly is the control terms. So how many board seats that you want to give to VCs, and also the voting power, the veto powers, etc. So what is like a VC investment process? So here I want to share a funnel with you guys. It's just for illustration purpose. It might differ according to different VCs, their profiles, but basically it's like the general standard process. As you may know that VCs, they have different ways of working. Some VCs, they have more a formal investment process, while others will be have a less structured investment process. So basically, at the start, they source deals. So like I said before, so the deal flow is really important for them. They identify investment opportunities at this stage, whether either through some networking events or through some their personal networks or some ongoing discussion with entrepreneurs out there. And then they spend time in screening and evaluating your company. Basically, this step is just to narrow down the deal flow that they have at the beginning to select some preliminary deals that are most likely compatible with their investment strategy. And if you're lucky enough, then they will start a preliminary due diligence process on your company. And at this stage, they will give you a term sheet and will start to negotiate with you guys some key terms that I will outline afterwards. And of course, there's a big part is about negotiating and closing the deal. So like I said, that basically when you go out there, raise your first round, like C round or Series A. Sometimes you spend like 60% of the time just negotiating liquidation preferences instead of other terms out there. So this step is pretty tricky and takes quite a bit of time. So don't underestimate the negotiating part. Once the deal closed, so that there will be the holding period. Some VCs, they might have only 1 year invest in your company, and then they will seek out for an exit opportunity, while other VCs will tend to kind of hold the investment for like 10 years, up to 10 years, until they got a really attractive exit window out there. And basically, statistically, we can say that over 1,000 projects received under deal flow, in the end, there will be around 20 investments made by VC in the end. So it's a pretty competitive process. So you should really have the details and the tricks in mind, and so that you can outperform your peers out there. So here I want to show some key terms on the term sheets. It's just not exhaustive, but give you a preliminary idea. So like I said, that term sheet is a non-binding letter of intent that the investors will give you if they think that your company match their investment strategy and you have a potential on your market to be the next unicorn. And basically term sheet helps investor identify some risk and problems in the business prior to signing the final binding agreement with you, which is called share purchase agreement. And of course, the term sheets actually they will list some conditions precedent. Most of the time, it will be some legal documentation that needs to be completed before they sign the binding documentation. Or also some additional conditions will be like completion of satisfactory due diligence, etc. And so if you have any questions, feel free to jump in. I want to do it an interactive session, and I think definitely Daniel and Klaus, you can also jump in to add some more comments. And also, like here, I list some key terms in the term sheets. So basically, you have valuation, liquidation preference, we just mentioned, anti-dilution clauses, which are just clauses when VCs when you raise next round and probably the valuation of your next round is lower than your previous round. So anti-dilution is just kind of a clause to protect investors. And board seats and other protective provisions, like any constraints that you need to be compliant, or other things that you could not done without approval from your investors. On the right, I just want to share some examples of the standard terms in term sheets. So here, the first paragraph, it's about the valuation. So most of the time, VCs will ask you to issue the employee option pool. Most of the time, they will ask you to issue it at the pre-money valuation, so that they don't want to be diluted. And then the second paragraph is more about vesting provisions. Most of the time, you have a schedule on 25%, 75% vesting schedules. But this, again, it's a standard one, and it might come that you can have a different schedule with investors. And finally, the last example is more about your devoting 100% of your time to the companies. You shouldn't have other projects besides this the startup company. Is it clear?
Yes, very much. Yes.
Okay.
Yes, thank you.
Okay.
Can I maybe add something that I think it's very fundamental, and it's the difference between a business angel and a VC. That I think it's important for the startup to understand the psychology behind it. Yeah. And the first difference, the business angel is investing his own money, and the VC is investing other people's money. That means the business angel is per nature is interested in every single deal that is invested in. So it does really care to every single company that is invested in. The VC is thinking about a portfolio. So if he has 10 companies in the portfolio, he knows that 3 of this company will make up for the 7 that he will kill. So if you're not good enough for them, they're not going to support you, and they're going to squeeze you out. For that reason, it's very important that you read exactly the clause, the liquidation preference clause, to exactly make sure that they're not going to squeeze you out because they say, okay, no management attention anymore needed, and so on. So that you're very clear as well on the timing, so that you make sure if a VC invest in you, how much time do they have to deliver the return to the investors? Because if they, like Wen said, if they have just 1 year and then the fund closes, that means in 1 year you need to provide a return that they are expecting.
Yeah, thanks, Daniel. So I want to share the key steps in VC investment stages. So again, it's more centered around the venture capital. So it's I mean, for business angels, it's less probably it's not that applicable to angel investors. So basically, you have a seed funding, so which is really at the beginning of your journey. So like I said, that at this stage, companies, they aim to complete research, product definition, or product design. So it's more like a prototyping, and you don't really yet have customers out there. So at this stage, the amount that you will raise is more or less than 1 million euro, and the forms that will that the investor that will take to invest in your company will be either a safe, convertible notes, or preferred stock. Convertible notes is just basically just debts, so you will pay like interest to investors on a regular schedule, while safe is just another alternative form to convertible notes, which is actually invented by Y Combinator in the US, but the purpose is just to simplify the whole process, and that the relationship between VCs and the startups are just simpler, and also that it's not a kind of form of debt. Preferred stock is just equity. And then we have the second stage is later if your company grow, expand, and you have already shown some initial traction. So that we're moving to the startup funding, which is more like a Series A and B round. At this step, mostly the amount raised will be more than 1 million euro, and it's most of the time in preferred stock, so in equity form. And at this stage, capital is more likely used to fund your working capital and to cover your capital expenditure. Most of the time, from seed funding to from seed round to Series A round, investor will actually look for a period of 36 months maximum. So it's like 3 years maximum. So if a startup they like kind of go over than 36 months, it might be alarming to some investors, meaning that your company is not growing fast enough. So I think that this time should be a kind of a benchmark for you. And then finally, we have later stage funding, which is just basically the rounds after Series B. Most of the time, this round will be over than 30 million euro. And this capital raised from this round actually to use to make to scale your business and to make your business more profitable. So what are the profiles of startups that VC will back? I would say that VC are constantly looking to invest in startups which offer great upsides and attractive exit opportunities. Like I said in the beginning, so VC's job in the end is to realize profitable exits in order to have a capital gain so that they can return money to their limited partners and to realize their capital gains. And here are some of the investment criteria. Again, this is not exhaustive, but I think it's the most important. So definitely, first of all, you need to be positioning on a rapidly growing market in which you can quickly capture a significant market share. So most companies, they have a good idea, good projects, but sadly, they're actually targeting a market that is not large enough. When I mean large enough means that the market, there will be no potential space for a eventually publicly listed company. So if like markets where you cannot hold eventually publicly listed company, it is a kind of like a small market, and it's quite alarming for investors because they definitely don't want to invest in companies that could not have a huge market potential in the future. And second is the team. The team quality is really the kind of the top criteria that investors look at, especially European investors. They tend to prefer a team with already some entrepreneurs on the team and also have some already relevant industrial experience on the field that you are working on. And finally, it is about your business model. So it means that your business model should be something that is quite easy to be scaled on a global scene, and that you can have like proven product market fit and hyper growth quite rapidly, and also in the end, path to profitability is really important to them. So here again, I just want to highlight one thing about hyper growth. When I say hyper growth, I mean growth can be different kinds of patterns of growth, but in VCs, it seems that they are really looking at growth patterns that are exponential growth, not linear growth. Linear growth means that this year or next year or the next 3 years, you have like 10% growth each year. So that's not hyper growth for investors. For investor, hyper growth is that this year you have like 10% growth in your revenue or customer base, and then next year you will probably have 30 or 50% growth. So this is like exponential growth is something really attractive to them, I would say. Any questions?
It's Klaus. I'd just like to add some comments here from my VC recently gained VC perspective, because I have an angel investor experience now. Now I'm entering in the VC industry, and I observed already the VC industry over the last couple of years. I mean, why are the VCs so keen on this exponential growth or on this hyper growth? Because the statistics shows us that out of 10 investments, there might be only one really strong growth company, which might become a return of 10 times the invested capital. But if you have in your portfolio of 10 investments, one who is bringing 10 times the invested amount, then you have equally invested, for example, 100,000 in a seed round in 10 startups, and the one with the 10, your winner basically, the champion, he brings just the invested amount back. He brings just 1 million back if you have invested equally, and that's why that's this power curve in this VC industry, that you really need to find at least maybe 2 of them which have maybe 10x, or you have 1 10x, and then you have at least 3 with a 5 times x return, 5 times multiple, so that you over 7 to 10 years, then you will have in that example, you might end up with an interest rate of 14%, 15% per year, which the challenge for the VC industry over the last 10 years, that the stock exchange was brought so much return that there are in certain markets, especially in the US, for example, US stock exchange, there have been returns around 9%, 10%, 11%. And if you then come with a high risk approach, investing in high risk young companies, startups, and you can just prove that you make 14, 15%, that's really a big challenge for the VC industry now. So, but this you need to understand that this is out of maybe 10 investment cases, there might be only 1 or 2 who really over 5, 7 years really developing quite strong, and the other ones, there are some might die, go bankrupt, and some others are doing okay, but not but just doing okay with some revenue and not providing a good exit potential on the multiples, is then for a VC not that interesting. So, for example, in my case, I've invested in 18 startups over the last 10 years. There are 6 of them provided a positive return. My best return is an 8x return, and the lowest one was 1.5 time return. And 8 of these companies already went out of business, and 4 of them are still developing quite good and quite well, but there's still a question mark how many of them will really make then a fantastic exit at the end. So this is quite unclear still, but so just that you understand why the VCs are so keen on this exponential growth, on this hyper growth, because they really do their bet basically on this type of companies with a very strong scale up potential.
Yeah, of course. And market consensus says that usually if you raise a series or seed round or series A round with annual recurring revenue at $2 million, then you need to definitely get to $6 million in your ARR in the next coming 12 months. So it's challenging, but I think you guys are on the right track.
I got another question, if I may. Do you hear me?
Yeah.
Well, okay. This graph you're showing here, when we come to prove that, or to tell about our prediction, we use the business plan. I suppose that the business plan is the most valuable tool in that case. But this is at the beginning. They don't look at the business plan, and they have to somehow evaluate if the startup which is presenting them will be capable of doing that. To provide this kind of graph. So,
yeah.
What are the mechanisms from the point of view of the VC to evaluate such a thing without looking into the numbers? Because that's very important for us when we come to present. And until now, we presented a lot of VCs. And I think it's only hunch, because I don't see any other tool they can have any clever evaluation of that besides going into the numbers. And also after going into the numbers, it's not for sure, but without that, it seems like science fiction. So what is the how business look at that?
Let me ask a question. What makes you think that they don't look at the numbers?
Because of the first presentation or the second presentation, if you weren't asked to present your business plan, so there is no business plan to look at. No, the discussions
because
at the beginning, there are no numbers.
Basically, they were not interested enough in what you presented to ask you for the business plan, right?
Yeah, right. So,
okay, so
but this is a very important criteria, this graph. So what is the tool, the mechanism of evaluation besides this hunch at the beginning? Is there any answer for that?
They look at your market growth, the market potential, the potential of the team, everything, every criteria that when just listed. In fact, they looked at your business plan. The business plan and the figures that you offer are just the execution plan. But and of course, you must have given them some rough figures on where you want to be in 2 years, 3, 4, 5 years, kind of roadmap, rough figures. But that's enough. That's enough. They don't need to go into the details of your execution if they are not convinced that the market you're working on will be an exploding market. You can have a big market if the market is not growing and is not promised to explode, and for some very clear reasons, there's no need to go into the execution. You don't need to understand your execution. There's a business case and a business plan. The business case is how you perform onto one business area, and the business plan is really the execution.
From a pure investor point of view, I can tell you why I ask numbers is to understand if you understood the drivers of your business. So you need to understand the market, you need to understand your margin, you need to understand what is possible. And if I have that, I have the good feeling that you understand the numbers that you put down and you can argue why they are like this, then it's good enough. I know that at the end, the number will be different anyway. But what I want to know, can you manage numbers? Do you understand the drivers?
Exactly. And for example, I as well, I always need to understand. I mean, typically we have then we receive a pitch document or a pitch even then if we invite then companies to pitch on any of these events, and there's normally a Q&A session. And if you present your deck in 3-5 minutes, for example, which is always a challenge, and then there are coming some questions about your business model and about your the scale up, the growth, for example. And as well about the team, for example. I mean, if I see that there's already now a prototype available, or you have already the first customers, then my question would be, what are your capabilities in the team? So the sales and the market access capabilities. because very often startups are quite good, the founders are quite good, and that's part of their entrepreneur gene they have, so that they are quite good in selling the first products themselves. But then if they have to hire salespeople, that I have seen in the past now quite often of time, that a lot of money was wasted by hiring very famous salespeople, but then the sales is not really gearing up, because the salespeople they still have not it was still not the right product for their type of relationship with customers, and so it was a waste of money, or it was too early, hiring too early the salespeople. So it's and this is something I need to understand. Do you if a startup if they have some sales experience in the entrepreneur team, in the founders team, and if not, whether there is someone else in the broader team, or whether they have thought about their strategy on what is the strategy, the go-to-market strategy. And if there are coming vague answers, then I would lose my interest in looking deeper in it. That's how I see it very often in a lot of cases.
Okay.
Yeah, just in one word, traction is really important at early stage for investors. It's a kind of the guarantee for them that your company will really generate profitable return for them in the future. Okay, let's move on. So what is like a startup journey like? So like we just covered on the previous slide. So basically at the Series A seed stage, you should generate around 1 million ARR, annual recurring revenue. And you have a founding team, so you have like preserving cash is one of your top priority at this stage. And then moving on to Series A, so you will generate more ARR, and then you will actually have already some customers, at least 5 to 6 customers in full deployment, and you have validated your product market fit. And then Series B round, that your ARR must reach like 10 million euro, and that you still have secured customers in your portfolio, and you have a strong CFO that will help you scale your business in different countries. And last but not least, a clear market and product positioning. So in terms of exit strategy, we talked a lot about how startups should work and what kind of efforts that they should make in order to really attract investors. And then once investor invests in your company, of course, you should also work on your exit strategy. So basically, we have like 3 different types of exits. M&A, so you merge with another startup, or you are acquired by some large groups. So here I share 2 examples, like Jump, which was acquired by Uber. Both of them are startups in the mobility sector. And Amazon and Flipkart. Flipkart is actually a e-commerce startup in Indian market, and Amazon saw the huge potential of this market in India, so they acquired Flipkart. So these 2 examples illustrate the M&A opportunity and strategy that you may have for your company. And then the second option will be IPO. So you sell a part of your company to the public in the form of shares. I want to share an example, which is called a startup Snowflake, which actually just did their largest software IPO back in September. So Snowflake is a cloud data warehouse. They got public listing on the 16th of September this year. And what is really, how we say, surprising is that their stock price actually surged from $120 to $253 just on the first day of trading. So you see the potential of startups in software business that can have for public investors. And the last option will be just liquidation if things didn't go turn around really well, and you actually didn't secure market share or any customers, then you will probably just sell off your assets and the market value and stop the business. We talked a lot about VCs, how VC work, and what are the criteria they use to assess startups, their potentials. I want to add a few more words on the value added value of VC. So I think most of you think that. Sorry, someone want to
interrupt you? Maybe just one point to your preceding slide.
Yeah.
It's just to make clear to the startups, because I see that there is a lot of confusion about the exit strategy. As an investor, you are likely to be more happy with an M&A transaction at the end, and not an IPO, because an IPO means usually it takes much more time until the exit. Because an investor, yes, he believes in your project, but in 5-10 years, he wants his money back to invest in another project, because he gets every day new project that he is looking at, and he says, oh, I wish I had more money now to invest in this project. So just keep in mind that an M&A is more attractive for an investor or a straight sale than an IPO exit.
Okay, so if we go back to the added value of VC, I think most of you think that probably VC only give you financial support, but that's not all, because according to a research by Invest Europe, startups that were backed by VCs actually grew faster in terms of assets over the 6 years following the VC investments. So when we say that assets, we mean by the number of employees and also the scale of your revenue. So basically, it's illustrated from this graph here. So what really are the additional value that VC can provide to startups? So here are some of the additional value. They're basically on the reputation and your brand, because most of the time we say that you raise a round with some famous VCs that will get you some brand recognition. And the VCs will actually provide their network to your company so that you can access some additional customers or partners from their networks. They will do some mentoring for you on your business model, on your go-to-market strategy, and also your sales marketing strategy. And also that most of the VC investors, they are actually entrepreneurs in different industries, so they can definitely provide their own experience and skills to help you scale more quickly the company. Here are 2 examples of VC investors to illustrate their added value for startups. Pure Terra is actually an early stage investor specializing in water technologies. So they make actually investment in startups that create a positive impact on the environment. One of the key initiatives that they launched is actually organize the largest international water trade show in China for startups and corporates, so that they can actually share contacts and create business opportunities together. And Axel is one of the top VC, early stage VC in Europe and the US. They actually just launched an online learning platform for entrepreneurs, which is called C2 Scale. So you have different programs and the modules that actually teach you how to target customers, how to create targeted content, etc. I want to quickly share just some top seed VCs and Series A VCs. So here we have the top 5 seed stage VCs. They actually they are all like interested in tech startups, and most of them invest in internet and the SaaS business. Point9 Capital which is actually just raised a new fund of 99 million euro in September. They are focusing on B2B marketplace and the SaaS business. One thing to highlight on point 9 is that they actually have the best C to Series A conversion rate in Europe, meaning that the percentage of their portfolio which go on to raise a Series A after raising a seed round is actually lower than 36 months. So they are one of the best VC funds that have this tick this metric. And another thing to mention is that when you see the Series A VC and the seed stage VC, you basically see that Series A VCs, they actually invested in a lot more unicorns than seed stage, like Index Ventures, Excel, etc. They all invested in some of the most well-known unicorns in Europe, like BlaBlaCar, Lookout, Deliveroo, etc. So here just a list that give you some ideas, but definitely this will not be your target list of your investors because it's quite a general list. I should definitely adapt your list according to your sector, according to the amount that you want to raise, and also according to the track record of these different investors, whether they have already invested in robotics, hardware business, etc. So we talked a lot about the startups, how as an entrepreneur you can manage to succeed in your startup business. I want to talk about this another topic, which is why startups fail. As we all know that the failure rates in startup business is actually quite high, but this is not some topics that we have massively covered in the media. So we want to talk a little bit about it. So according to CB Insights, research by CB Insight, it seems that the top 3 reasons why startups fails comes down to market need, run out of cash, and not the right team. So when we say that no market need, basically it just means that the startup are actually not solving a market problem, or you are not solving a large enough problem that could be served with a scalable solution. So we have already mentioned a little bit on that on the previous section. And run out of cash is another key critical point in the startup business. So whether you can secure enough funding at the right time to help your business finish the prototyping and scale your business with the additional customer that you can gain is actually critical at the early stage. And the final point is the team. So like I said before, the team quality is really important. And if you have a team that doesn't have the same vision and the same guidance or the direction to go towards, it's most of the time difficult for you to really scale your business and to execute your idea fully. So here are some examples of failed startups. So we have 4 examples. I will talk about the first 2, and then Daniel and Klaus will comment the next 2. The first startup's failure that I want to share with you is a startup called Juicy Roll. I guess some of you have already know this startup, which is actually a hardware startup, we can say that. So this startup was actually founded in 2013, but unfortunately it was shut down in 2017. So you see the life expectancy is quite small. Juicy Roll is actually inventing a new juicing machine that can help consumers cold press their juice more efficiently. So they actually managed to raise $120 million since 2013 before shutting down. And the company is actually working on a very was working on a very trendy topic, which is about healthy diet alternatives. But unfortunately, it doesn't work out. So why the project doesn't work out? First of all, it's because that machines was actually selling too expensive. They're actually selling the machine for $400, and the functionality of the machine is actually quite limited. And it turns out that consumers can press juice as efficiently by hand as just by their machines, so that their machine, the hardware that they're building, is actually not solving problem or significant problem on the market. And second of all, it's just there's no customer willing to buy their machine that are just not solving any problems for customers. And also another key takeaway is that they are building just a machine to impress investors, or hardware that is not really usable by consumers. Definitely something not recommendable for our future startups. And second example is actually a startup in the biotech, which is called Theranos. Theranos was actually a startup established by a woman called Elizabeth Holmes. She was actually one of the prominent students that dropped out of Stanford University at the age of 19. Because she dropped out of the university just to build a startup, which is a blood testing startup. And she was actually called the world's youngest female self-made billionaire back in 2010, between 2004 and 2018. But sadly, the startup actually was shut down in 2018. And currently, she is actually going through a federal trial with the US government. So what is Theranos actually doing? So they were actually building revolutionary blood testing device, as you can see on the photo on this page. They actually want to create a blood testing device using smaller needles and the smaller quantities of blood samples, but somehow they didn't manage to bring out the product to the market. And it's because a lot of the things that they actually were selling to investors, just like a story on the paper, is not really just something. Actually it doesn't turn out into reality, and the product doesn't work as it intended, and there are a lot of inaccuracies in their blood testing technologies. So there are a lot of deceptions from investors, and it's actually one of the largest biomedical fraud in the US. So what they did is actually they were just overselling the idea, their prototype and the product to investors, and they really have some problem of trustworthiness with the investor community. So these are the two examples of failure. And so like probably Klaus, you want to comment on for Everly?
Okay, I was on mute. Sorry. Yes, for Everly. For Everly is an e-commerce startup who introduced a wedding marketplace, so that the wedding event could be fully organized by this marketplace with all the different supplier services you can imagine. And wedding is quite an average wedding event. People spend between 6,000 and 20,000 euro, even more. But it's like, so this was the span of the target segment for Everly, and they took then a commission on this on the spend, which was organized and ordered, purchased by this marketplace. What happened that they what we saw in Germany is that abroad, in the UK and in the US, etc., there are some in the bigger countries that already some very successful wedding marketplaces establishing themselves. So we saw the growth of this market, but still all of them are still very national organized. And so for Everly, on the beginning, they attracted 3 business angels with the first investment. One of these business angels is a former well-known startup entrepreneur who made quite a big exit to a company, to a media company with his startup. And so he was like already, his brand, his personal brand was associated already with Everly. This allowed for Everly to be introduced on this TV show, the Lion Cage, Höhle des Löwen in Germany. And so the founder of Everly, she was pitching on this show in 2016, I think. 2016 around was she pitching there. And she got as well then one of these lions invested as well, quite a well-known person. And but then what happened then that she was for Everly faced that they have to change something in their IT architecture, so that that there was some technical investment they need to do, so they could not really run the platform already on full speed and on full success. So there have been some technical changes need to be done, and the existing investors lost then already a little bit the interest, and especially the lion investor, I would call the investor from this TV show. He just 1 year after he invested in Everly, he changed his investment focus to a total different, less startup, more real estate all of a sudden. I mean, he is a very rich person, but somehow he made some bad experience with maybe some startups, and then he changed his mind and moved his investment focus to real estate and no longer in startups, in technology startups. And the other angel investors from the round before, they somehow followed this. They as well they lost already a little bit their passion with this with the startup. At that time, we from Go Beyond, there was a group of investors came in after this TV show. After she got this TV show investor on board, we came a little bit later. But the problem was that the early investors, they already had like 30% of the equity, and as they stopped basically the investment, for the smaller investors, for the angel investors who followed, but we had maybe 5 or 6% of the shares at that point. For us, it was just far too big to cover the gap for the next investment round. And despite market demand was existing, the trends abroad have been very promising for this market. We have not been able to solve the company. We tried to find a solution with an acquisition, with a fire sale, with an M&A boutique together. We tried to find one of these abroad companies, one of these who might enter the German market, maybe or already entered the German market now, because this is like a 1.5 year old, this story. But so we tried to introduce at least an M&A deal here to rescue the founder team and the employees, but even this was then not possible, and so the company had to declare bankruptcy 5 years after the founding. So the conclusion was basically it was the investment strategy. So the founders, she was quite happy on the beginning to get very famous investors on board. She was not ready with the solution, so she could not make, when the TV show happened, she was not ready with the solution to make a benefit from this free marketing and advertising, which happened at that time. So it would have been good to make this this investment in synchronization with that you can really run the whole marketing and benefit from the marketing. So that was a lack of synchronization with the startup development and with this different investment. Very promising investors came in on board, I have to say. I mean, most of the startups might be very happy to get touch names on board, but in reality, at the end, it was a disadvantage to have these investors on board. It would have far more better to have smaller angel investors on board, which are longer committed for a long-term commitment to help the company to really to bring the solution on the market. That's my conclusion out of this experience.
And we have Begin Medical, Daniel.
Yes, I was so lucky that I didn't invest in Foreverly. I've seen the pitch and everything, but it's because I didn't have money at that time and I wanted to spend it in Bergen Medical. That that was as well a failure, and it's a similar experience. It's really Bergen Medical. What they do, it's a medical device startup in the US that makes when you have when they do incision, that they have a system that really worked, that they didn't make infections. So it was really a good thing. They had the technology, they had everything, and that was fantastic. What they didn't have was a good investor strategy. So they could not manage cash. And then so since they didn't know when they need money, how much they need money, they were constantly raising money. And then in doing so, they would have as well down rounds. And down rounds would be that they would have to go back to the investor and say, hey, look, we did this mistake. So they were always just in mode of raising money. They spent the last 3-4 years trying to raise money. And then at the end, the whole process took so much that they ran out of money. And as easy as that. So really important for you, the lesson learned out of it, really make sure that you have a clear investment strategy from the beginning, that you know exactly when you will need how much money to be successful, and then work really you plan, bind it to the milestones, and make sure that you can run this plan, and there will be delta, but with the time you can always explain why. And another lesson learned for a startup, in my opinion, is make sure, because the investor always does a due diligence on you when they invest. Do you as well a due diligence on the investor. Make sure that the investor has aligned targets and goal as you have, that they share the values, get them on board, include them in the process, make them part of your journey. And because you need investor when it's bad weather, not when it's good weather. And for that reason, really make sure that you are aligned with your investors. They are stakeholders. They're not just money givers. So that's my lesson learned on Bergen Medical.
So I will make a short statement here. When you look at the study that was published by CB Insights about the failures, in fact, there's never one reason for failure. Here you have market need, run out of cash, and so forth. But basically, the main KPI is your sales. Do you sell? Do you sell your product? If you don't sell, maybe it's because there's no market need, or maybe no market need yet. It's a question of timing. You run out of cash. Why? Because you don't sell. Not the right team, because you don't manage to sell. It's very often a question about sales. When do you start to sell, and how much and how fast? And do you have enough cash, since you are a hardware company? Do you have enough cash to generate enough enough turnover and to have this cycle of sales initiated organically without investors? So as long as you can sell, you will be in a safer zone, basically. And all the regions that you have listed here, very often it's not just one question, it's not one region, it's a combination of all of that. And it all comes to, you run out of cash. Why? Because you don't sell. That's main point. And that was my main message for this.
Okay, so let's move on. Okay, so we talked a lot about the success story and the failure and how VC works. So when it comes down to you guys, how will you prepare your fundraising and when to start actually raising money. So basically, here are some of the tips. So I want to say that investors, they do have some windows throughout the year. So you definitely want to capture these windows when you go out there to raise money. So usually it's in October, November, and March. So most of investors, they go on vacation during summer and Christmas. So you definitely don't want to launch your fundraising process at this period. So capture these windows will really help you to secure enough attention from investors. And also you need to definitely budget at least 6 months before going out there to raise money. 6 months is actually the minimum lapse of time that you need to secure from the moment you start preparing and from the moment you start contacting your first investor. And also asking yourself the following questions before launching a fundraising process. So first of all, like Daniel already mentioned before, so really make sure to understand why you want to go out there raise money. So how will you use this money that you will raise from investors? What are the next milestones that you want to achieve? The metrics that you want to accomplish? And of course that you need to have the vision. Where is your business headed? So what is really the vision that you want to share with these investors? And then also really spend time and think hard enough to figure out some unique economics and understand these metrics inside out, because investors, they will challenge you from all aspects to see whether you understand how the business model will work out, what are the unit economics, and why you come up with this percentage or this number. So you should definitely get prepared to answer this kind of questions and to show that you fully understand the industry, your business, and your sector. And last but not least, choose your legal advisors in advance. Having a good legal advisor will really help you save a lot of time during your fundraising process. Some lawyers, they actually don't have a good understanding of startup business. They will kind of spend a lot of time negotiating some terms that are not important for startup founders. So be sure to do some background research on legal advisors and to see whether they have good reputation or they have successfully helped some entrepreneurs secure deals with investors.
And maybe to add something on the legal terms, just try to use standardized terms. Don't invent the wheel again. There are different standardized contracts. Just make sure that that you keep in the article that are important for you, and you kick out the one that are not so important. But try to use standardized wording and then contract. Don't get draft your own, because it's, and then try to treat all the investors the same way. Don't do too many different, because that's going just to make your life miserable in the future.
So focus on the key terms in the term sheet is really important, because there are really a lot of terms in this standard document. Not all of them are important for you. Just really focus on the key economic and the control terms that will have an impact on your future business decisions and your relationship with your investors. Okay, so I want to share some tips, quick tips on how to prepare your fundraising process. So you definitely want to start by knowing your own need. So we have already mentioned that throughout the presentation, cash is really king. So running out of money is really not a good sign for your business. So make realistic assumptions on your monthly spend. So what is your burn rate? So how long can you sustain with the cash currently in hand? So this is really important. The first step, you need to do that. And because a lot of founders, they kind of have really not a clear idea of how much time they can sustain with their cash currently on account, and they don't have a clear idea how much additional cash they will need for the next phase. And again, determine how much you want to raise and the length of time that you will have until reaching next milestones on your business. So when I say milestones, basically I mean number of customers, your revenue size, and all the other critical metrics and all operating metrics that you can have on your business. These are really important to investors. So it shows them that you have a structured method and you know exactly how you will go forward with the investment that you have already have with your money. And then the second step will come down to preparing your fundraising materials. Basically, you have these 4 types of materials to prepare. An executive summary, so most of the time a 1-pager or up to 3 pages document, a presentation, just giving a quick and concise description of your business, your idea, your team, and what is your solution. So this document, the purpose is really to kind of knock the door of the investors, try to arouse their interest to give you a first meeting. So this is the purpose of executive summary. And then you have an investor deck. So it's about 20 pages PowerPoint presentation outlining the equity story that you want to sell to potential investors. So this document, I think most of you have already a preliminary version. You just need to elaborate on this existing version to add more probably traction, slides on tractions, and your financials and why you want to raise money and how you want to spend money. So I think you will have more in-depth discussion with coaches later during the next few months. And then if you have a demo and a prototype, definitely don't be shy to share this with your investors. They're more than happy to see how products and ideas work out, especially for hardware startups. So this is really critical. And last but not least is a business plan. So I would say this material is more or less in the middle of your discussion because like nowadays investors are more focusing on investor deck and the demo prototype, and then later they will probably ask you for a business plan, just for more details on your go-to-market or your financials and your business model. And then the third step is to identify the right VCs. So we mentioned that not all VCs have the same investment strategy, and not all VCs are looking at the same types of startups. So you definitely should do some segmentation on the VCs out there, do enough research on them to know their team, know their strategy, know their track record, try to see on their portfolio what are the companies that actually have the similar industry and business model as yours. What are the companies in their portfolio are actually your competitors? And also definitely you should have an idea on their preferred deal flow channel. So you can do this by approaching some of the entrepreneurs that they already invested in on their portfolio. Most of the time, this is a good way to approach a potential VC instead of just going out there to do some cold mailing or cold calling. This is not a way that VC prefer, I would say. Try to get some warm introductions from them, even through events or through your personal networks. This will really help. And also, one additional advice is that always try to over communicate with our VC investors, with any potential investors actually, because it's really important to help them embark on your journey, help them understand the ups and the downs of your business, and try to build a long-term win-win relationship with them. Trust, here again, trust is really critical between you and the VC. Like I said previously, we have a startup failure case one of the critical problems is the trust. So if you have a trustworthy relationship with VCs, most of the time things will work out quite smoothly. And one last suggestion is that you should start preparing your due diligence list in advance. That means that you should start preparing the list of documents that might be requested by VCs during the due diligence phase. So this could include some legal documentations like your company registration document, cap table, any commercial agreement with customers and suppliers will also be a critical element that VC will look at, and also employee contracts, board meeting minutes. So here the list is not exhaustive, but basically the VCs will do due diligence on your business, technology, operation, I would say, as well as legal and financial. So just try to have a preliminary list of documents in mind will help you save a lot of time once you start the process with them. And last but not least, this is really important, that be transparent with them. If there is any legal issues or any disputes or any problems, just don't hesitate to share with them. Don't hide things from them, because once they invest their money in your company and they figure out the problem by themselves, it will be catastrophic for the relationship that you are building with them.
If I can add here, the last point is very, very important. And in addition, I would put as well, it's not just money. A lot of time that you may be looking for. Maybe you are looking for a network. You're looking for people to support a part that you're not good at. So just think wider than just money. Think about smart money. What do you really need? Where are your limit? Where are your limitation? You have to know what you know, and you have to know as well what you don't know. And what you don't know, maybe it's a good way to tell as well, investor, I would need help in the sales. I don't know, whatever it's you need, but be very clear on that as well. It's not just about raising money. It's about raising smart money.
Yeah, I would say that investors really here to help you, but keep in mind that you should still have a clear vision and guidance in your mind. It's not a good approach generally to ask investor, what do you think that how should I sell my products and how shall I approach customer? You should share some of your ideas and elaborate on that with investors. Show them that you have already the conviction and you know, but lack of resources is another question, then lack of knowledge. I think I'm clear enough. Yeah.
And there are some VCs. I mean, what Daniel said is especially true as well for angel investors. So that an angel might be a very senior business professional entrepreneur who brings a lot of network and experience to the table. But the same is now true as well for a couple of VCs out of Europe. They are specialized. Some of them, the classical VC model is that you invest in maybe 50 startups, and then some of them develop quite well, and then you continue, and then you make a return. So that is one part of the strategy. But there's as well now there are a couple of VCs which follow the strategy as well, that they implement operational teams. So it's not just the analyst, the financial analyst, or the company analyst they have in their team. They have as well quite big, sometimes quite big execution operational teams who can run certain activities for their portfolio companies and complement the team, for example, if you need a controller on time, etc. So there are a couple of VCs now, they try to differentiate them from the rest of the classical traditional VC world, which with some additional services they offer to their portfolio companies. So, and this might be as well, I think that's then part of your segmentation when you look around on the VC landscape, which might be then the best fit for you.
Yeah, definitely. So just to conclude the presentation, so I think most of you probably during your startup life, you will probably come into these fundraisers. So just a quick note on the role of these fundraisers. But basically, these are the middlemen between startup and their investors. The way they work is that they charge a retainer fee on a monthly basis, and then a success-based commission on the capital that they manage to raise for you. So they are actually acting as a bridge between the founders and the VC investors to help you raise capital. So I will not go deep into their role, but it's just for your information. And here I listed some current, fundraisers out there in the market, and you can see some of them are quite classical players like Big Four auditors and their investment banks. So I think this is all for today's presentation. So if you have any questions, we're more than happy to answer.
It was very educated. No questions, but
Yeah, same here. It was very thorough. Thank you.
Thank you, Ben. Thank you so much.
Yes,
Do you
thank
think
you.
that the information we gave, because I know that some of you have already raised some money. I know Automato, you have already some grants, and others, some of you have already raised 1 million euros, something like that. So what is your preliminary feedback or your insights on your interaction with investors?
Do you mean feedback on investors for the next round, or for
on your experience, your experience with investors on the money that you have already received?
Okay, so we have mainly raised primarily 2 rounds, one pre-seed round and then seed round, and I think yeah, like my in general feedback has been pretty positive. I think one of the most important things that we did was to be able to showcase the story properly. Like there was like investors were really happy with the amount of preparation that we did, and this comes to the point. I think somebody asked this question on like anyway, the financials that we make right now, the business plan that we make right now, it's not going to be anything close to that in the next 5 years. It's going to be drastically different, but at least from my perspective, what I saw was investors were more interested in understanding, are you ready to put some effort into understanding the market? It might not be correct, it might be wrong, it might be right, there might be definitely changes and deviations, but like, are you prepared for the questions that they are trying to put up? Are you actually thinking about the real market gaps and the various stakeholders that could that potentially exist in the industry? Of course, we are not going to get everything correct on the first go, but yeah, that was basically the main thing that I personally think has been useful to us up till now. And right now we are already starting the process for Series A. So we will see. I mean, we're talking to a couple of investors. We're talking to Sequoia right now, 8 Roads, Capital, Atomico, and also our existing investors, because all of these are ones which can potentially, which will potentially put money in the Series A round as well. So I guess we will see. I think especially as part of this program in the next, so my target right now is to get a term sheet by February or March, because we have a major change in medical regulations coming in May. So it would be important to raise the money, raise money before that, so that we are ready to start selling again in Q3 of next year. So yeah, I think I think it will be interesting to see how much development we can do with RobotUnion in the next 3 months with respect to that.
Okay. And the others?
Yeah. I will have to leave the meeting, but if there are still some questions that you can stay, of course.
Regis, one last question to you. You said about the feedback on the business and the technical side. So are we going, and there was, or there must also be some feedback from the investor sessions and things like that. Are we going to get it over email, or how can we get access to that?
We will give you that during the first meeting with your coach.
Okay, perfect. Thank you.
This will be more one-on-one discussion with your coach. I have a document which is an Excel file which I need to share with everyone, and so that the common vision can be given. Okay, I need to jump to my next meeting, so I will and leave the control of the meeting to Wen.